Hi there, everyone, and welcome to this month's edition of On Track. Rob McGregor here. It's the 29th of September as I record this. We had our investment committee meeting in Sydney on Friday and just updating for all the news up to then and performance to the end of August. So let's dive in. But firstly, a warning. This video is prepared for clients of McGregor Wealth Management, particularly those that use our care investment process and methodology. For everyone else, we don't know your circumstances. You shouldn't act on anything you hear about in here without talking to us or someone who gives you advice. So we're going to cover all the latest economic news, and we're in a kind of holding zone at the moment. It's not that interesting, but the markets keep making new highs. And there's some good reasons for that as well. And I'm going to go through all of those, including updates on inflation, interest rates, and the economy, and an interesting property market in Australia as well. So let's have a look at the news. And globally, the economy's showing a lot of resilience, and this is in spite of clearly the tariff uncertainty that started last year and continues to the moment. But that uncertainty is not translating into crazy bad economic numbers. There's a little bit of inflation worries in the States, and there's a few things, but generally the world's growing at nothing exciting pace, but it's certainly growing, and growth is good. We've seen rate cuts in Australia. We see that, last month, not this month, but 3.6%. Powell, the head of the US Fed, acknowledged that a rate cut is going to soon be warranted. Now, the markets always celebrate this. It's positive for shares in the short run. But you've also got to remember the good news, bad news. The reason they're dropping rates is because economies are slowing. So that means they're taking away the handbrake of higher interest rates. So even though it's good news that rates are down, it's bad news that the economy is slowing. Now, eventually, that will catch up. So the cycle here is the worse the news, the more the rates get dropped, and that's good because eventually low rates is very, very positive for share markets, property markets, etc., and it leads to growth. Same thing in Australia. We've had weak employment data, and that just means, forgive that typo there, that should be data. That just means unemployment's lifting a little, and that just means the Reserve Bank is likely to drop rates. The market is forecasting that going down to about 3.1% for the cash rate. So that would give it another 0.5% to go. For those on mortgages, that's going to mean mortgages end up closer to 5, and maybe even some 4s in that. We've dropped, the mortgage rates are dropping, to the low 5s, mid 5s at the moment, depending on which institution you're at. So Macquarie, which we've got there at 5.44. So 0.5% off that would be about 5%. Now, the market's forecasting that as what we call the terminal the cash rate, which means that would be the bottom of this cycle. Now, of course, it can go lower. It would only go lower on worse economic news than we've got at the moment. And it could stop before then and even go higher if the news was good. So if we went into a boom and if there started to be signs of inflation, that might lead to higher rates. Not much action around the 90-day bank bill rates or 10 years. They're fairly stable. Same with the Aussie dollar. CPI under control. Look, it's jumped by the mean I've got here, but the trimmed mean, which is the one that the RBA follows, is back down at 2.6%. The reason the CPI has jumped here is because all those bribes the government did on power prices to lower inflation over the last year to try and get the Reserve Bank to drop rates have fallen off, and that's pushed CPI up to 3. But the trimmed mean, which is the one the RBA follows, is at 2.6. So tick for inflation, but cautiously in the States, it's bumped up a little. That little's still under 3% for them as well. But there are analysts worrying about inflation from tariffs, so that's the worry there. But it's interesting that Powell has predicted or acknowledged that rate cut soon might be coming down. Term deposits coming down slightly as well, and getting back into the normal range. You would expect to see them at closer to 3% by the end of the year. So that reinvestment rate in term deposits will be dropping, and lower rates is positive for share markets. And that's what we've seen. So performance numbers to the end of August are rock solid as I cast the cursor down the 1 year. conservative portfolios at 7, right up to high growth portfolios at 15. And you've seen international, the star of the show, and the active portfolio are doing incredibly well with the help of gold plus international. We still have the markets at expensive, so we haven't changed that the last few months, and that's because even though the markets are making new highs, that's been justified by a mixture of lower interest rates and good profits coming out of the reporting season. So no reason to make that more expensive, but certainly no pullback to make it less expensive. Now, expensive is just, it can be expensive for years. It doesn't mean you should be out of the markets at all. I'll share some long-term reasons shortly to reinforce that. When we look at the long term and those targets on the right down the bottom here, and the 10-year returns for care, and care's just celebrated, I think we're coming up to 11 years, so it's a long time. We now manage $4 billion in total in care, which is quite a celebration considering there was zero under management 11 years ago. We have, however, been using the philosophy around care since 2001. So it's about 24 years old, the philosophy, and doing very well. And the month was positive there again. An update to the 20 years. And I like this slide because it just shows a whole market cycle, not in particular order, but it emphasizes the wall of worry, where we have these continuous drops of 12 to 20%, which don't count as bear markets, but they're quite regular. 7 since the GFC. More than 20% counts as a bear market. Obviously, COVID was that, but the last one now back in 2008-9. It's been a while. Now, we also haven't had a boom since 2004 to 2007. As much as this feels like a boom, you can see it's still pretty much fitting into the shape of that line. Maybe it's developing into a boom, and a boom can go for years, as I'll show in a minute as well. Right now, actually, I found this chart, which I love. You guys know I like my long-term charts. Well, this goes back to 1870. Which is the US stock market. All those sources are down there, but it's a compound, it's a cumulative real wealth. You cycle there. All the lines, the light blue lines and the dark blue lines, I've added. So, and I've added them for a reason, which I'll talk through. So the red line is the US shares, and you'll see these waves of markets going up. It's funny, the wall of worry fades out when you put this long-term view. You can't see all the interims in between. You can certainly see the big downturns, the Great Depression, World War One, and influenza and a whole bunch of other stuff back then. Inflation, that was the Cuban Missile Crisis, rise of oil prices. But they've also, all those big ones have also come off the back of crazy price uplifts. Now, I've put on the side the slope of that. So before the Great Depression, and you look from 1920, after a period of pretty ordinary stuff, as they came out of the First World War and started to grow crazy, and with lots and lots happening, particularly in motor vehicles and the roads around America sort of stuff. But that increase you can see on the right here, that's the pace of that increase. Now, the light blue lines, the three parallel ones, is the average over that whole period. And then you can see in these crazy booms, and this is when we get FOMO, when it's almost vertical like that. And then it was again in the, back in from about the mid-90s through to 2001, where we had the dot-com boom. And that one is the one I'm hovering here, the second dark blue line from the top. And you can see the shape of that. And even the shape of the rise post Second World War, where you had the mass consumerization of the US, where everyone had a car, everyone was buying washing machines and all those types of things, from TVs to just consumer appliances, all massively increases. And if you look at the shape of the line where we're at the moment, so this is the S&P 500, or this is US shares. So the US shares did have a so-called lost decade, where at the end of the dot-com boom, it came back to earth, and then it was coming good again completely, and then we hit the GFC. So that looks terrible there. But if you go through this middle line, you can see that it kind of was a crazy boom. That's the FOMO, came back to earth, was just starting to go again, and a genuine crash, and then back again. And then we had our last little downturn back there. So the shape of this downturn is still not into what I would call full-on craziness or FOMO yet. And we're in one of the biggest technological changes in history with AI, robotics, and med tech and all these other things providing a great impetus to share growth. And the fact that AI will um, cut a lot of costs in businesses, which is going to boost profits, is what the share market is voting on at the moment. So even though you may hear some people talking about bubbles, we certainly don't believe this is anywhere near in bubble territory yet. And I'll talk through why when I go through each of the markets. And I went through last month. The bubble can, back in 2000, the market literally doubled 3 times in about 5 years. It's had one double in 5 years at the moment, so not anywhere near that crisis. Now, in the exciting life, boring money section, this is where I highlight some of the stuff going on for people that are chasing something special. Now, Latrobe, some of you may have seen, I had friends talk about Latrobe. They market their investments as if they're term deposits. They are not term deposits. They take money and they lend it out to people as mortgages, but they lend it out to second tier mortgages for the most part, people who can't get mortgages off the banks. Now, ASIC put a standing order on them to stop people investing in their 12-month term account. Now, just notice the language, 12-month term account. Sounds like a 12-month term deposit. It is not a 12-month term deposit. They offer rates like 7, 8, 9% for that. So they're lending it higher. So now ASIC's lifted that, but it was a clear shot across the bow, and they had to change the language they use in their advertising completely about what it was suitable for, etc. So it's good to see ASIC getting in front of this private credit. And private credit covers a lot of things, but we mean unlisted credit where you can't quite see what's going on. And quite clearly they're pushing returns above normal. Picture, banks giving people term deposits of 3.7%, lending at 5%. That's the normal for people. Now, whenever you're being promised returns of 7, 8, 9, 10% for fixed income, they're lending their money out at much higher rates. And it brings back memories. One of the risks ASIC's taken now and is that by naming this, people may stop investing in Latrobe, or worse, some people might start to pull their money out. If we get more instances of this, we can see, we see what happens. And I've cast my searches back to 2007, and there's an article here from the Fin Review, bottom right-hand corner, when there used to be a popular fund called the Howard Mortgage Fund, and it was similar in some ways to Latrobe, similar but different. It was a good fund. It was actually quite popular. It paid everyone a decent return, and it lent out money for mortgages. But in the GFC, it had to lock up as people started to try and pull their money out. And keep in mind, if they're investing, if they're lending their money out to people in mortgages, they can't just call in those loans. So all of a sudden they had to close the fund of redemptions. Everyone tries to get their money, and the fund had to be wound up. So it was wound up 7 years after 2007. It was a 27-year-old fund. It had never had losses. And it was wound up. Now, people kind of got their money back, but they couldn't access their funds for 7 years. And this is the territory that I fear we're moving into a bit with private and unlisted credit. So be extremely careful. You'll see us avoiding it completely. We don't feel the need to chase that at all. As always, there's plenty of good products there, but they're more for investors who are very on top of where they're going. It's a worry for me because there's been a proliferation of money going into this sector. And whenever there's more money goes into any sector, the quality of the deals they do, so the quality of the lending in this case, but in parallel, you've got in private equity, the quality of the companies they're buying goes down because price goes up. Wherever lots of money goes, price goes up. So anyway, watch this space, and it's an area we're comfortably avoiding at the moment. Not to say we will forever, but for now, we're definitely avoiding. Yield curves, you see, they're for the last, what are we talking there? In Australia, I'm looking at the bottom right here. For the last year, we've just been converging around that 4.3%. The States around 4.1, a little bit up, a little bit down, nothing crazy. The yield curve in the States, still predicting lower rates in the short term, but then this bump up. And quite interesting, we talked about this a lot in the investment committee. At the long end, 10 years plus, not much change in the last 6 months. And that's because people are not certain, even though short-term interest rates are coming down, they're not sure long-term interest rates are going to stay down with that fear of inflation. Certainly that's the case in Australia as well. We've come down a little bit, but not by that much. So fairly stable 10-year government bonds, but shortening at the front end, both in Australia and the US. As always, just our analogy, which I talk about, the wall of worry. We still view ourselves as in the wall of worry at the expensive end, but certainly not into that boom. And note once again the slope of the lines. My caricature there of that market is a very steep rise in the boom compared to the ups and downs in the wall of worry. So still calling that a 10. I won't go into those today. I've highlighted in the most investors mess it up section illiquidity just to reinforce those private markets. Only three ways to lose money from long-term investing. One is panicking, having to sell, or not being truly diversified. And part of that having to sell gets down to illiquidity. If you see someone invested in a whole lot of private assets and those assets freeze up, then all of a sudden they have to sell a whole lot of everything else. They can have perfectly good assets, but if they're frozen and if they're not paying out income, that means they've got to sell other stuff, including sometimes their house, which is why we don't love illiquid markets. Behavioral bias, which we see whenever we get to a new high, is loss aversion. All of a sudden, when we're at new highs, people feel like the market's got high, therefore it's got to come down. But new highs can run for years. You saw back in that chart I showed of the 150 years, a lot of the time the market was at new highs. I'm actually going to go back to that now because I just want to illustrate. You go back to post World War II and that, and back to say the 1950s, the market gets to a new high. It kept going for 20 years. It was the most prosperous time in America with that mass consumerization. And it's just a series of new highs, new highs, new highs. Now, eventually it consolidated, but that was partly FOMO, partly economic crisis from the Cold War, Cuban Missile Crisis, etc. Then we had breakout, and then new highs in this case for nearly 20 years again. So even though we're seeing new highs at the moment, you can easily have new highs here that could keep going through to 2030, consistent with those 20-year extremely prosperous periods. So just wanted to highlight that. And when we get to those new highs, people do worry about, they think that automatically there's more chance of having a loss, but not necessarily, depending on what's happening. Once again, I would point out whenever things are interesting, we just keep coming back to that process that the best financial decisions are made for part as a plan, and that puts everything into context and makes the portfolio management so much more specific to your circumstances. So let's have a look at what shares are doing. Aussie market, a good month at 3%. A solid year at 14.85%, absolutely. 5-year returns at 12%, so a good 5 years. 10 years is 9.82. That is the 100-year average, pretty much, just around that. So not in a crazy market. It's taken the Aussie market about 7-8 years to double at the moment. That's in the pretty normal range. And I talked a few months ago about the Commonwealth Bank. It's actually come back a little bit while the rest of the market's gone up. So that's eased its percentage. It was up to about 12 or 13% of the ASX 200 at one stage, but that's eased a little. US shares, a flatter month, up 0.5%. Nothing wrong with 0.5%. That would be 6% for the year. And you can see quite solid for the year, and 3 years at 20%. So the US market has doubled in just under 5 years at the moment. Now that 5 years at the moment takes us back to 2020, which was about as we were coming out of COVID. So 5 years at the moment. Returns look extremely healthy because we're coming through the bottom of a dip. If you look at the bottom right-hand chart, you'll see the dip there was COVID. So 5 years ago, the dip, 2020, let's go back to this dip. That was the tech dip. The COVID dip here in the US. We're now 5 years from just there. So we're coming from the bottom or the trough. So that makes 5-year returns look good at the moment. And part of that's just statistics. which I've talked about. Global leaders, much the same stocks there. Yeah, a very small but okay month, but then 24, 23, 23 over that 5-year period, 15% over 10 years. So the global leaders, that's the top 100 companies as well, have just been, yeah, amazing. Small caps have come back a solid month, and this is why we love diversification. There's always something fighting back. And in this case, they've had quite a 3 years at just 9%, but it wasn't so long ago. We're talking about 3-year returns of 20%. As we came into COVID, US small caps were up about 20% over the previous 3 years, and they've been flatter over this period. But we're just starting to see this rotation as people take profits from big stocks and that's pushing up. And the message here is always how awesome is diversification, because as we rebalance through this and pick up, we pick up. And this has been a classic. 1 year ago, emerging markets had a terrible 5 years. The 5-year return was down about 5%. It's had a 20.7% return this year. So quite amazing. And that persistence to continually rebalance and buy during those down periods and then enjoy these gains is what pays off. Gold, just incredible, 40%. As people worry about the long-term stability of the US market and alternative currencies, and gold is up basically on the back of that alternative currency theory. Into properties in our cycle, they're similar, boom, but we call it boom, bust, boring. Property prices don't tend to crash the way that shares crash. They just go flat for long periods of time. In some areas, they can go down, but very rarely. I thought I'd add sort of headwinds and tailwinds and a bit of news and trends as a lead into the charts on this. So we're in this falling interest rate market, and that supports upward price pressure on property. Simple demand and supply. Price of debt drops. That means people have got more budget, and that pushes price up. All other things being equal, which they are at the moment. So that upward cycle at the moment has been driven by an undersupply of good properties. And even though last year the increase in dwellings of 53,600, so there's now 11,373 dwellings in Australia. That needs to be much higher to suit the current population, and that's why there's price pressure on the upside. But it's in the right direction, which is a good thing. The mean price, that's the one in the middle, in Australia is up over $1 million, rose by 14,000, went through $1 million the month before, but that's the middle price in Australia. It's not the average. Averages are distorted by the highs in particular, but that's the one right in the middle. And that increase means that in the last 5 years, since COVID, property price have increased by 60%. Now, in some places, they've increased by 100, in other places, not by much. I'll talk about that in a minute. But yeah, unfortunately, depending on which way you look at it, the undersupply is going to persist for some time. And pretty much everyone agrees on that, which is always a bit scary. But what this means is conditions remain solid for property investing. And we're seeing that. And yeah. I've left this chart in from last month because I just want to re-emphasize that when we do get the start of a rate cut cycle, the next few years are pretty good. So this is the change in house prices in the 2 years after the start of a rate cut cycle. So no negatives, all positive, and the positives range from a massive high of 60% to 32 to 12 or 13. So generally, from the start of a rate cut cycle, good news for the next few years, and I think it will be for property investors as well. So we're seeing this with 12-month changes, solid, not crazy, and I kind of always like solid increases because whenever you get crazy up, there's always the risk of crazy down. So monthly, pretty consistent. Melbourne's still the slow coach around at the moment at 0.5% for the month, but still positive. If that annualized, that'll be about 6%. So it's a good sign for Melbourne. Perth still the front runner, about 1.4%. And you can see over the last 12 months, good solid returns from Brisbane at 8.4%, Adelaide 6.1%, and Perth 6.9%. This, of course, is changes in the prices, which is on top of the rental income that someone would receive. There's the mean. We mentioned just over 1 million around Australia, and you can see the variability of that state by state. So New South Wales, 1.2 million, Victoria, 800s, Queensland nudging up towards 1 million, South Australia and WA. And that's the total value of all dwellings. It does include units, so it averages them all out. And you can see the rental yield, so that's the return you're getting, is pretty steady. It dropped a bit in 21, then came back up. But 4.4% in regionals, 3.5% in capital cities. You'll note that that's pretty much around an interest rate, which is fairly common in Australia, certainly in recent history as well. And yeah, it's a decent return. By the time people pay their rates and other costs, the net rental yield, this is a gross rental yield, is lower than that, and then the growth on top. Mortgage rates, with the rate cuts, we're now seeing rates come down, lowest in the marketplace, about 5.3%. These headline rates around 6.15 are only what you should not be paying those. So you should be closer to 5.5. These are what I call the bank sucker rates, where they leave people on older rates and they don't bring it down to where their new customer rates are. You should check your rates if you're not in the mid fives. And if you want to be aggressive, you can even claim that you can get 5.4, 5.3. 5-year rates are now starting to come down to the mid fives. For many investors, we would encourage them to use 5-year rates where it locks in certainty for them. And that's not for predicting. There's two reasons you lock in an interest rate. One is because you're predicting they're going to go lower. Now, it's very hard to predict rates, where they're going to go. Everyone makes the attempts. They're not always right. And even if variable rates drop some more, that doesn't mean fixed rates will drop. They may be steady. It depends what people think about the long term. So the second reason to fix rates is if it makes your budget more certain. So in other words, if you're buying an investment property and it makes sense for your cash flow wise with a 5-year rate, then sometimes it just means it's smart business to lock in that cost for the next 5 years. And in that time, rents will go up and protect you somewhat as well. Not too many changes in the property clock, but you can see, and I've got our friends at Performance Property Clock on the left. I've still got the Heron Todd White one in there as well. They're not the same, and I like the fact they're not the same. It should just re-emphasize that no one knows what's going to happen. They're a slightly different focus as well. Heron Todd tend to try and show what's happening, whereas Performance probably tend to show where it is relative to the value in terms of buying it, and where the downside risks are. So some quite disparate things, but they're still seeing the emergence of good buying value in Melbourne after a period of time. Heron Todd White still has Melbourne falling. That's because they are, but that falling now is putting it into good value, and they still see good value in Perth. A little less so in Brisbane, but Brisbane's certainly the best value of those that haven't been in the doldrums. We're seeing the Sunny Coast interesting near the peak, although do note that Sunny Coast keeps getting wound back as the demographics change, as people move from those higher priced cities of Sydney in particular to the Sunshine Coast. And that's it. I'm just going to reinforce, as always, our exciting life, boring money philosophy. And that is quite simply, we believe people should have an exciting life and boring money, and not the other way around. That means we aim to manage your money well, so you don't have to worry about it and you can get on with living a great life. And the fundamental principle behind that is the best decisions are made as part of a real plan based on your goals and what's important to your portfolio designed to meet that. We take a long-term view, but we are mindful of shorter-term stuff. And the 3 principles of long-term portfolio allocation and diversification: asset allocation and maintaining liquidity, which is so important, and then low-cost index for most of the growth markets. And we protect against the inevitable short-term volatility through reserves for our retired clients, averaging in for our accumulation clients, and then the magic of rebalancing, the free lunch. Rebalancing is worth somewhere between 0.5% to 1%. So it clearly pays the bills, pays the fees when it's done well. And yeah, there is only 3 ways to lose money on the market. And congratulations to all our wonderful clients who don't do this. Panicking and selling, having to sell, and not properly diversified. That's it for this month. I'd always appreciate the time. Anyone that gets to this, respect. And until next month, this is Rob McGregor signing off.